Most financial news focuses on the stock market's daily headlines. We watch fluctuating ticker tapes, assuming they represent the peak of global finance. But the $100 trillion stock market is entirely overshadowed by the $143 trillion bond market. While it stays largely out of the public eye, this market acts as the primary engine for global capital. This massive pool of debt is how governments and corporations fund their largest projects. When they need to build national infrastructure or a multi-billion-dollar aircraft carrier, they rarely pay for it up front. They borrow the money from investors like you. This market also carries a documented track record. It has signaled every single United States recession since 1960, before they actually happened. To understand why this market is such a consistent forecaster of downturns, we have to examine the specific rules that govern these trillions of dollars in debt. At its most basic level, a bond is a tradable loan. It is a contract between an investor with cash and a massive borrower who needs it, typically a corporation or the U.S. Treasury Department. This loan is defined by two main rules. First is the face value, the exact amount you are lending, which is typically $1,000. Second is the maturity date. This is the specific day in the future when the borrower promises to pay that initial $1,000 back to you in full. To pay you for the use of your money, the borrower pays you a coupon. This is a fixed interest rate, let's say 5%, that is paid to you every single year until the loan ends. Because the amount, the end date, and the interest are all fixed by contract, bonds create a predictable income stream. This certainty is why they are often used as a safe haven for capital. But if these contracts are guaranteed, why do their prices change every day on the open market? Bond prices and new interest rates move in opposite directions on a seesaw. In 2022, if you held a 2% bond and the government suddenly paid 5% for new ones, no buyer will pay full price for your lower return. To make your old bond attractive to a buyer, you have to lower the price. When interest rates shot up in 2022, old bond prices fell so sharply it became the worst year for bondholders in modern history. The math only works if you hold the bond until it matures. On the open market, those fixed payments can become a liability if newer bonds start offering better deals. This entire system also relies on the borrower actually paying you back. Lending to the U.S. government is a world apart from lending to a struggling cruise line. To track this, the industry uses a grading system. Highly secure investment-grade companies like Apple are ranked from AAA down to BBB. Below that line, you enter the world of junk bonds, debts from companies much more likely to fail. The real danger happens when a company's financial health fades and its rating slips below that BBB line. The industry calls this a fallen angel event. Many large investment funds are legally banned from holding junk bonds. The second a rating drops, they are forced to sell the bond for whatever they can get, which causes the market price to crater. That single line between investment grade and junk is the boundary between a safe return and a catastrophic loss. Now that we understand how yields and risks work, we can see exactly how this market forecasts economic trouble. This is the yield curve, which tracks the interest the government pays on its debt. Normally, if you lock your money away for 30 years, you want an extra return for the wait. This upward slope is the sign of a healthy, growing economy, where investors are comfortable looking toward the long term. But sometimes the curve flips. This is an inversion, where a 3-month loan suddenly starts paying more interest than a 30-year loan. This happens because investors are so concerned about a crash in the near future that they scramble to lock their money into the long-term safety of the 30-year bond, even if the interest rate is lower. This specific signal, this mass shift in investor behavior, has appeared before every single United States recession since 1960. You don't need a high-level trading desk to use these tools for your own financial stability. For most people, the simplest entry point is a bond fund. This is a single basket you can buy that holds thousands of different government and corporate loans. You can find these using search codes like BND or AGG. For maximum safety, you can buy I-bonds directly from the government. These are designed to change their interest rate automatically to make sure your savings are not eroded by inflation. We look at the stock market to see where wealth is being built. But we look at the $143 trillion bond market to see how that wealth is protected.